Welcome to the Stock Guy Analysis. So today we're breaking down the absolute chaos that recently hit the crypto market. It was a massive stress test, one that sent some serious shock waves through the whole system. But what it uncovered about the future of digital assets, and one technology in particular, well, that's the real story. Okay, let's just dive right in. To really get where we're headed, you've got to understand what just went down. A massive historic liquidation event that shook the entire crypto space to its core. And get this, it was even bigger than the collapse of FTX. Here's how we're going to break it all down. First, we'll unpack what actually caused the crash. Then, we'll see who stood tall when everything else was falling apart. From there, we'll dig into why Ethereum is starting to look like critical financial infrastructure. Then, we'll zoom out to see the absolutely massive multi-trillion-dollar opportunity this is all pointing to. And finally, we'll look ahead to 2026. So what on earth actually happened? Well, the market was already feeling the squeeze. I mean, you had all these storm clouds gathering, threats of a government shutdown, a Fed that was dead set on keeping interest rates high, and just this general feeling of economic uncertainty. It all created this cascade of problems and basically sucked all the cash, all the liquidity right out of the market. And here's the kicker. The forced selling that happened on October 10th was the single largest liquidation event in the history of crypto. Let that sink in. It was bigger than the FTX collapse. It was bigger than the CEO shock back in 2020. This thing was huge, and it exposed some really deep cracks in the crypto market's plumbing. You know, the hidden mechanics that nobody ever sees until they break. So, this whole mess got kicked off by a feature on some exchanges called automatic deleveraging, or ADL. Now, it's supposed to be a safety feature, right? If you borrow money and the value of your collateral, the stuff you put up to back the loan, starts to drop, the system automatically sells it off to cover the debt. But when there are no buyers around, that safety net can turn into a trap due real fast. And that's exactly what happened. It all started with a sudden price drop in a few smaller stable coins. Now, these things are supposed to be safe, collateral pegged to the dollar. But when they suddenly plunged by as much as 40%, the ADL systems went into overdrive. It was like a tripwire. It set off this chain reaction, this cascade of foreselling that just ripped through the entire market. So, you have to wonder, right? In the middle of all this unprecedented chaos, how did the two biggest players in the game, Bitcoin and Ethereum, actually hold up? Well, the answer tells you pretty much everything you need to know about their fundamental strengths. And this chart, wow, it just says it all. While so many smaller crypto projects got absolutely wiped out, I'm talking down 80% or more, Bitcoin and Ethereum were incredibly resilient. They only dipped about 7%. Now, in past crashes, you might have seen them fall 30, maybe 40%. This time, they barely flinched in comparison. They acted more like mature, stable assets. And that resilience really boils down to their completely different roles. You've got Bitcoin, which is best thought of as digital gold. It's a store of value, simple as that. But Ethereum, that's a whole different animal. It's a smart contract platform. Think of it like a programmable world computer, a foundation that you can build almost anything on top of. And that difference is absolutely crucial for where this is all going. Okay, and this is where the story gets really, really interesting. Because of that programmable nature, Ethereum isn't just being seen as another currency. It's being positioned as the potential foundational layer, the actual backbone for the entire future of finance. So, why is Wall Street suddenly leaning in so hard? Well, it kind of boils down to four key things. First, security. The Ethereum network is massive and decentralized, making it incredibly tough to attack. Second, reliability. It has had 100% uptime since it started, a track record that even traditional finance can't always boast. Third, it's being developed in a way that's seen as Wall Street friendly. And fourth, longevity. It's been around for about a decade, which in the crypto world is an eternity. And look, this isn't just some far-off theory. It's happening right now. You've got those stable coins, digital dollars being used for payments. You've got decentralized finance, or DeFi, trying to rebuild things like lending and borrowing without the big banks. You've got prediction markets that are, get this, proving to be freakishly accurate. And maybe the biggest one of all, the tokenization of real-world assets, putting things like stocks and real estate on the blockchain. All right, let's pull back the camera for a second and look at the real price here. This is bigger than just crypto. The true scale of the opportunity here is about tokenizing the entire global economy. And hey, don't just take my word for it. When a CEO of BlackRock, literally the largest asset manager on the planet, says the goal is to tokenize everything, stocks, spawns, all of it, you pay attention, that signals a monumental shift is underway. So, to really wrap your head around what that means for value, let's start with the baseline. Right now, Ethereum's entire network is worth somewhere around $400 billion. That's a huge number, no doubt, but it's just our starting point. Now, compare that to global GDP, the value of all the economic activity in the world for a whole year. We're talking $90 trillion. The scale is already just completely different. But we're still not at the main event, because the real prize, the market that people like Larry Fink are eyeing, is the total size of all global financial markets, stocks, bonds, credit, you name it. That is estimated to be over $300 trillion. The jump in scale is almost hard to comprehend. So the vision here, the multi-trillion-dollar bet, is that we're at the very, very beginning of this massive migration of value. Moving even a tiny fraction of that enormous $300 trillion market onto a blockchain like Ethereum would cause an absolute explosion in value for that underlying network. Okay, so what does this all mean for the next couple of years? Where's this train headed? Well, a lot of analysts are calling this Ethereum's 2017 Bitcoin moment. You might remember that year. It's when Bitcoin burst into the mainstream and Wall Street finally started paying attention. Today, Ethereum is seeing that exact same kind of surge in activity, in developer adoption, and in institutional demand, with predictions of over 1 billion active crypto wallets by the end of 2025. It's really positioned to be a defining force heading into 2026. But here's the twist. This cycle is fundamentally different. Ethereum's value isn't just being driven by speculation and hype. It's being driven by its utility, its real-world use as the infrastructure, the base layer that's powering this new wave of finance that institutions are finally starting to take seriously. Its value is actually tied to its use. So while all the short-term price swings and crazy liquidations grab the headlines, the long-term story here seems pretty unmistakable. Ethereum is evolving from just a promising idea into a cornerstone of a new digital financial system. The breakout we're seeing right now might just be the opening chapter of its biggest story yet. Don't forget to subscribe, and thanks for watching.